Hi investors, Nick Garner here from Investmore, as you can see from the, the background. Anyway, I want to go through some new data we've got that I think will be helpful for you, our clients, and anyone else interested in this kind of stuff. So let's get into it. And the very first thing I'm going to do is show you this. So we'll start with postcode district data. And we get our postcode district data from property data, and they update this data constantly, so it's very current, to use a term. And I'll go full screen so you can see things better, and I'll make it a bit bigger for you. And I'll zoom out. Now, the way we use this postcode district data is to look at sales and rental turnover in a given area. And for example, here in Manchester, we can see here we've got a kind of anomalous situation where the dark bit in the middle represents high demand, and the outside circle represents high demand for renting, and then the outside circle represents high demand for sales. So for example, here it's high demand for rent, but not much in sales, less demand for rent, but higher demand for sales, for example. And how do we read this? Well, it's a fairly simple calculation. I just use the raw data because it's on our system and I kind of know how to interpret it. But I have got the same data here, but organized in a very different way. And I've used an algorithm just to kind of help me work out roughly or created a little algorithm or formula just to help me tune this up so that it's a bit more realistic, because bad properties hang around forever. Good properties sell quickly, but the majority of properties will sell quickly. And what happens is properties that hang around pull down the averages and therefore distort the data a little bit. And therefore what I've done is I have added some commentary and given a suggested time for how long it takes to sell a property, and also for how long it takes to rent a property out on average. And if I go to M6, for example, let's have a look at that here. You can see M6, and it's got a strong sales demand and quite strong demand here, and that is kind of true. So the rental demand has eased off a little bit, and but anyway, it's a strong market all round. And I'm saying and a lot, but anyway, okay, that's that. The next thing is when we want to have a look at the capital growth in the postcode district area. And I'll just show you this. I'll just make the boundary visible so you can see what the postcode district looks like. Show layer. There we go. And then we can see roughly what areas we're talking about. It's quite important to have these boundaries because then there are certain areas which are very depressed in terms of activity because maybe people don't want to live there, but other areas are very strong, and therefore when you work at it, look through it on postcode district level data, you've got to average it out. Anyway, that's that data. Now the next is I'll go in, and the next is the MSOA data, which is much more granular and in many ways I think much more useful. And MSOAs are typically 5,000 to 7,000 houses, and as you can see here, we have this area. It's just a random patch, and from this we can get some insight into what's going on, and I'm going to explain how this interprets. I've done this so it's number of sales each year per 1,000 people living there, because I figure that's a more standardized way of looking at this. And following the dark is hot, the light is cool. The outer ring represents number of sales per 1,000 people. I have done some correlation analysis, and generally speaking, there isn't much of a relationship between the number of sales per thousand people the and the price, the values. But I think what it does tell us is how much turnover there is. And obviously, if there's a lot of turnover in an area, then it means, so if you've got a relationship between high turnover and strong prices, then it means you've got more of a chance of finding something in that patch because more property will come up on average versus an area with very little turnover per thousand people. So I will zoom out and let's just find such a place. We can see, I suppose, let's have a look. Here we go. Here's something. And it's in 21, it was 1,000, 6 properties per 1,000 people, which is quite low. And let's have a look at that. And it's because it's very city centre, lots of apartment blocks, probably lots of issues with cladding, and that's what's going on there. And sometimes it's just, I don't know, I don't know why some areas wouldn't turn over very much. But anyway, that's that piece of data. And it'll be helpful for us to kind of steer clients into places where we think there's a combination of a lot of growth and an opportunity to find new property as it comes up. So a bad case is, for example, high growth, but there's very little turnover, i.e. there are very few properties around, so you're going to be waiting a long time to find something, and therefore it's better to go where there's more action, say around Swinton here, for example. We've got the capital gain, we've got plenty of properties churning around, therefore that is good. We can go and find nice properties for people in those areas. And that's more or less it. Obviously, this data is for the whole of the UK, or sorry, England and Wales. And I guess I'll just finish with a couple of things just to talk about different areas, because I know people are always interested in this kind of stuff. Areas that we're interested in at the moment are Sheffield, Crewe, Doncaster, and so on. So let's have a quick, and Manchester, of course. And let's just have a quick look here. What I'm going to do is zoom out a little bit, and we're just going to look at the colors, because the colors are really more kind of revealing in a sense, in that when you see lots of brown, you know that's good. When you see lots of green, that's bad. And so what we're looking for is that nice combination of, here, for example, around this little patch, we've got high turnover, we've got good capital growth, and hopefully we've got prices that kind of work. And I will just zoom in here. There we are. I just have to assume you're looking at this on a mobile phone, and that's why I'm trying to zoom in and out to make it visible. And the other thing, as a general rule, if the median house price is, say, for example, 200,000, then we know we're in a good place. And here's an example of an area where there's a lot of turnover. The median house price is okay, although there's a lot of social rented property around here. So is that, what's going on here? Well, wherever you have that correlation, it's because people are selling up their council houses, which they get for a discount, and then they're reselling onto the market, and that distorts the numbers a little bit. So there's all sorts of variables to think about when you look at different areas and what's working, what's not. Broadly, Sheffield is one of those cities which is strong now because of the time we're in, the period we're in the property cycle. It's not like Manchester. It's not as robust as Manchester. And here we have Chesterfield. What's going on in Chesterfield? And the answer is quite a lot. We can see here, this is a good example of an interesting area. Now, properties are quite expensive around here, 285, so they wouldn't necessarily work for buy to let. But goodness me, what a lot of turnover here. 20 properties per 1,000 population, huge turnover. So there's quite a lot going on around here, a lot of people moving in, moving out, and so on. So let's just have another, let's go to Doncaster. If I can find it, we have Mansfield and Worksop and Doncaster. Here we go. We've sold a few properties, or we've helped people find a few properties, should I say, in Doncaster. And there's a lot of growth and there's a lot of quite good value. My issue with Doncaster is that long term, it's done okay. Short term, it's very strong, and the prices are reasonable, and there's quite a lot of turnover here. And in my experience, there is a lot of property coming and going in these kind of places, and there is value here. And I quite like Doncaster overall. I think it's quite a strong place to buy. Another place of interest, of course, is Crewe. And we've helped a few clients buy property around here. Crewe is just not as strong, generally speaking. So if you think about Manchester being tier one, let's say, for growth and an overall outlook, Crewe is kind of tier two, or if I give it a 5 stars, right? So if I say Manchester is, for me, the probably one of the best places in the country, so I go to 4.5 out of 5. I give Crewe a 3.25. I give Doncaster a 3.8. So, uh, they're solid. But the thing about Crewe is that there's a lot of good yield in Crewe, and there's a lot of rental demand as well, which is good. So from that point of view, it works. It's not great on capital growth. And let's have a look at Liverpool very quickly. Now, Liverpool is, as ever, very patchy, I would say. So what I mean by that is that there are certain areas where there's incredibly strong growth, and others where really it's worth avoiding. And overall, when I think about Liverpool, the long-term growth story of Liverpool, it's not that healthy relative to Manchester. And what seems to have happened in Liverpool was in the last property cycle, and I talk about this all the time, so let's just have a quick look so you can see what I'm talking about. Markets, I do this on every assessment, by the way. I always talk about this, but I'm just going to say it again unless you haven't seen this. Right, and this tool, by the way, just looks at capital growth over time. You might find it helpful as well. 1845, roughly today, house prices based on affordability, which is a very good indicator. And look, all these peaks. There is even a little mini peak in the decline during the First World War. I guess that happens sadly when people die, and a lot of people did in the First World War, and thus house prices tanked. And cycle, peak. Interestingly, we are in a period very similar to the 1940s, and you can see a big peak here. Arguably, this is all to do with high inflation, high government debt, and people going to cash or going from cash into assets. And thus it drove the prices up. And there were supply shortages as well, of course. And here we are, 2008, and here. And so whenever I talk about this kind of stuff, I'm basically talking about the property cycle and how we are in the final leg of the cycle. Essentially, this boom phase here, this will probably top out in about 3 to 4 years' time based on historic precedents. And we're somewhere around here. We're about like a quarter of the way through. So the madness has begun, and in time to come, we'll look back and go, my goodness, wasn't property cheap here in 2022. The main point is that some cities did far better than others when it came to capital growth and decline, and different areas did well. So, for example, here we can see that in 2008, property peaked at 167, and it's now 140 because cladding issues, I expect. And we can see that from 2008 to 2021, in real terms, when you adjust for inflation, it's declined by 40%, which is huge. And people are kind of, when we talk to clients, a lot of them are like, well, capital growth's important. Yeah, okay. It's more than important, it's everything. Because if you get it wrong, you decimate your wealth. You get it right, and you generate a huge amount of wealth for yourself. And that's why this data is incredibly valuable, because it'll help you make good decisions on where to buy when thinking about the combination of yield and the prospective gain that you're going to get from this property over time. Anyhow, the thing with Liverpool is that there's a lot of short-term growth. There are certain areas which are interesting, and I'm I think there's value in Liverpool at this stage in the cycle. The whole thing is to just be careful where one buys and go for good fundamentals in Liverpool. But if I had a choice, I would always invest in Manchester, because I think that is really the tier one. So as a whole, I would give Liverpool a 3.5, because it is a big city, but I don't think it's an economically successful city like Manchester is. And I feel that it's somewhere akin to Sheffield in terms of quality quality. Places like Leeds are interesting. The issue is that there's a lot of cultural fragmentation, and thus the city is kind of split in many ways that way. So you have cultural fragmentation all over the place, which makes it a less successful city overall. And oddly enough, Manchester is just one of those places which has it all, i.e., there's cultural cohesiveness, and there is it's attracting a lot of very capable people. There's very strong immigration into the city with people who are economically productive. It's a successful place. The only issue is that a lot of areas are getting quite pricey, and the big question is whether it's worth buying into that on the hope that capital gain will keep gaining. And overall, I think as long as you buy sensibly, buy a nice property that people want to live in, then it'll work. And as I say to my clients, if it's a buy to let, you don't have to love the property, but you make sure that the property is a lovable one for your renters, so they look after it and they'll keep living in it year in, year out. Anyhow, I hope that there we go. I hope that was helpful. It's just a quick update, as I say, and you'll see this data on our property assessments, and I'm sure I'll do some more public YouTube videos on this, analyzing different towns and cities and things like that, and giving them scores, because I think that's quite a nice format and people like it, so I'll do more of it. All right, thank you very much.